What's up, everybody? One of our nation's largest home builders, KB Homes, released its fourth quarter report last week, which indicated more signs of a very troubling housing market. According to the report, KB Homes saw a 68% cancellation rate on new construction projects. The company reported a backlog of over 7,600 homes valued at around $3.7 billion, a 27% drop in units, and a 25% drop in value compared to the same quarter last year. In the fourth quarter, the company's net orders totaled 692 homes, down 80% from 3,529 in the same quarter last year. Gross orders for the company fell 47% during the quarter, and cancellation rates as a percentage of the gross orders totaled 68% compared to 13% a year ago. This is just one of many indications that the U.S. housing market is in serious trouble. Today we'll take a look at both Lance Lambert's article in Fortune about the housing market resets and how KB's latest activity affects it, as well as an article in Yahoo Finance titled KB Home Orders Plunge Amid Challenging Environment, to see what they both are saying. So let's just dive right in. Back in September, Fed Chair Jerome Powell said that the U.S. housing market would slip into a very difficult correction. He said that spiking mortgage rates would cause the housing market to reset, that it would eventually cause supply and demand to get better aligned so that housing prices go up at a reasonable level and at a reasonable pace, and that people can afford houses again. He did warn us that this would be very painful, and I think a lot of us are feeling the pain.
I can feel the pain in things sometimes.
Not only from the rise in interest rates and still high home prices, but it seems like everything these days is still just way too expensive. So when I heard about all the cancellations of new builds by KB Homes, I wasn't surprised. They're not the first builder to post higher cancellation rates. Both Lennar and Meritage Homes have also recently posted a huge rise in cancellation rates. In Lambert's article, KB Homes told investors that current conditions remain challenging. High mortgage rates and persistent inflation, together with an uncertain economy, have made home buyers more cautious since the middle of last year. As such, in the fourth quarter, we prioritized delivering a large backlog and protecting our high margins over taking steps to stimulate additional sales during the seasonally slower time frame. So in other words, they don't care about all the cancellations? I find that hard to believe. Take a look at this chart provided by Lambert and Fortune. As he mentions, historically speaking, a 68% cancellation rate is off the charts. Even in the darkest days of the 2008 era housing crash, the average builder cancellation rate only reached 47%. So why now? Well, it seems like a perfect storm of a dramatic rise in interest rates over a very short period of time, coupled with home prices that went up around 40% over the last 2 years, has caused the housing market to implode, and the builders will suffer. Some buyers are canceling their contracts because they're simply afraid that home prices will continue to go down in 2023, while others are no longer eligible for their mortgage once interest rates started going up high and over 6%. While favorable demographics and a prolonged undersupply of homes gives us confidence in the housing market's long-term outlook, current conditions remain challenging. Jeffrey Megzer, Chief Executive Officer of KB Homes, said in the company's earnings release, high mortgage rates and a persistent inflation, together with an uncertain economy, have made home buyers more cautious since the middle of last year. So what are all the builders like KB Homes going to do with all the inventory they accumulated during the pandemic housing boom? They'll start off by offering incentives like mortgage rate buydowns, but if that doesn't work, they're going to have to start reducing their prices so they can move all of their unsold inventory. They just need to be careful about reducing their prices, because it may really anger those buyers who are currently under contract, who then may cancel their contract. For communities that have large backlogs, particularly those with far more in backlog than remaining to sell, we're placing more emphasis on our temporary interest rate buydown and lock programs to help produce sales, and de-emphasizing price reductions until more of our backlog is delivered, Robert McKibney, the COO, said on the earnings call. But let's face it, if that doesn't work, prices will have to go down for them to move their unsold inventory. inventory. In Lambert's article, KB Homes told investors that they are getting more aggressive with pricing ahead of the spring selling season in order to generate new orders, and that they are pursuing reductions in direct construction costs and build times, which should help to offset the impact of pricing adjustments. KB will try to protect their comps, so they will try to reduce the cost by any other means possible before simply reducing the asking price on their homes. But at the end of the day, in order for their inventory to become more affordable, mortgage rates need to come down, inflation needs to come down, and their prices need to come down. As Lambert points out, even if the builders are reeling right now, they are still way ahead in the stock market compared to January 2020 share prices, so we really shouldn't feel sorry for them. That includes builders like D.R. Horton, up 78% since January 1, 2020, Lennar up 73%, Toll Brothers up 34.5%, NVR up 29.3%, Pulte Group up 25.2%, and KB Home up 1%. When asked about the rest of 2023, Jeff Kaminski, the CFO of KB Home, said, "There's just a fair amount of uncertainty out there right now, which is why we didn't guide beyond the first quarter. A lot of the remainder of the year will just depend on what the spring selling season holds, both in terms of new sales and what it takes to close out our current backlog." I don't know about you guys, but I just don't feel sorry for these home builders. I think they've had a runaway train for the last 2 years and have contributed to making housing simply unaffordable. If they want to offload their inventory, offer incentives, cut their prices, and help out the buyers, clearly by their stock performance, they can afford it. What do you guys think? Definitely comment below. Let's end the video with some data from REDFIN for the week ending January 12th and for the 4-week period ending January 8th. For the week ending January 12th, 30-year mortgage rates declined from the week before to 6.33%. The daily average was 6.15% on January 11th. Google searches homes for sale were up 50% from their November low during the week ending January 7th, but down 17% from a year earlier. This is interesting because it shows people are thinking about getting into the housing market after the holidays. New listings of homes for sale fell 21.9% year over year. Active listings, the number of homes listed for sale at any given time during the period, were up 20.7% from a year earlier, the biggest annual increase since 2015, which tells us that homes are staying on the market longer. Pending home sales were down 31.7% year over year to the lowest level on record, the 12th straight period of pending sales declining more than 30%. This number is really important because it shows the actual active activity right now. Among the 50 most populous U.S. metros, pending sales fell the most in Las Vegas, down 61.9% year over year, Jacksonville, Florida, down 57.4%, Phoenix, down 56.9%, Austin, Texas, down 55.3%, and Nashville, down 50.8%. The months of supply, a measure of the balance between supply and demand, calculated by dividing the number of active listings by closed sales, was 3.8 months, up from 3.4 months a week earlier and up from 1.9 months a year earlier. Homes that sold were on the market for a median of 44 days, the longest time period since April of 2020. That's up nearly 2 weeks from 31 days a year earlier and a record low of 18 days set in May. On average, 4% of the homes for sale each week had a price drop, down sharply from 5.7% a month earlier. This may mean that sellers are pricing their homes more realistically, which is a good thing. We're still in the early stages of 2023. We're at the end of January, so the next few weeks and especially the next few months will be very interesting to see what happens in the housing market. Hope you got a lot of value out of today's video. If you did get some value and you want to show our channel some support, definitely smash that like button, comment below, and subscribe to our channel. It just motivates us to make more videos. If you want to see other housing market prediction videos, definitely check out these next two. They're all from different sources. Thanks for watching. I do appreciate it. Bye!